Welcome to Chapter 1 of Applied Management Accounting. In this session, we're going to master one of the most important topics in your AAT Level 4 syllabus, Activity-Based Costing, or ABC. This topic is called the cost of clarity, for a very good reason. By the end of this lesson, you'll understand why traditional costing methods can lead businesses to make seriously flawed decisions, and how ABC provides the clarity needed to see what products and services actually cost. This isn't just theory for your exam. ABC is a practical management tool that can reveal hidden losses and unlock hidden profits. So let's begin our journey from traditional costing confusion to ABC clarity. Before we can understand ABC, we need to be crystal clear about overhead costs and why they cause so many problems. Overhead costs, also called indirect costs, are all those crucial business expenses that you simply cannot trace directly to a specific product. Think about rent for your factory, the salary of your production supervisor, depreciation on your machinery, or the electricity bill. These costs support the production of all your products. But you can't say, this specific £5 of rent was for making product A. Now, direct costs are easy. If you buy £20 of wood to make one chair, that £20 belongs to that chair. Simple. But overheads? They must be shared out somehow. And here's the critical point. How we share them out determines whether we see our business clearly or through what I call a fog of distortion. Look at the chart on this slide. Back in the 1950s, direct costs like materials and labor made up about 50% of total production costs, while overheads were only around 20%. When overheads are such a small fraction, minor allocation errors don't really matter much. But look at today's picture. In modern manufacturing, direct costs might only be 10% of the total, while overheads have ballooned to 60% or more. This is due to automation, technology, and increasingly complex business operations. When overheads are the dominant cost, getting them wrong isn't a minor issue. It's a critical failure that can sink your business. Exam tip: remember this shift from labor-intensive to overhead-intensive production. It's the fundamental reason why ABC became necessary. So how have businesses traditionally dealt with overhead allocation? Through a method called absorption costing. And it's deceptively simple. Here's how it works. Step 1. Add up all your production overhead costs. Step 2. Choose one single activity base, usually direct labor hours or machine hours. Step 3. Calculate one single overhead absorption rate to apply to all products. The formula is straightforward. Overhead absorption rate equals total production overheads divided by total activity level. For example, if your total overheads are £500,000 and you have 100,000 direct labor hours, your rate is £5 per labor hour. Every product then gets charged £5 of overhead for every hour of labor it uses. This approach has been used for over 100 years, and it's like using a sledgehammer when you need a scalpel. It's a one-size-fits-all method that assumes every product consumes overhead resources in exactly the same way, in proportion to whatever single measure you've chosen. In any modern business with diverse products and complex operations, this assumption is fundamentally flawed, and flawed assumptions lead to flawed costs, which lead to flawed decisions. Exam tip: make sure you can write out and apply this formula. The examiner often asks you to calculate traditional costs before comparing them to ABC. Let me introduce you to Oak and Pine Furniture Limited, our case study company. They make two very different products. First, the standard bookshelf. This is a simple design, mass-produced in high volumes of 10,000 units per year. Each bookshelf requires just 2 labor hours to make. Second, the custom entertainment unit. This is a complex, premium product, made to order in low volumes of just 500 units per year. Each unit requires 4 labor hours. Now, under traditional costing with an overhead rate of £20 per labor hour, let's see what each product costs. For the standard bookshelf, £30 of direct materials, plus £30 of direct labor, plus £40 of overhead. That's 2 hours times £20, giving us a total cost of £100. For the entertainment unit, £150 of materials, plus £60 of labor, plus £80 of overhead. That's 4 hours times £20, totaling £290. Looking at these numbers, management might conclude the bookshelf seems reasonably priced at £100, and the entertainment unit, at £290, appears to leave room for a healthy profit. But here's the question we need to ask. Are these costs actually correct? Spoiler alert, they're not even close. And that's what ABC will reveal. ABC is built on 2 powerful insights that change everything about how we think about costs. Insight number 1. Activities consume resources. When you set up a machine, place a purchase order, or inspect a product, you're using resources. Those resources cost money. Every activity in your business has a cost attached to it. Insight number 2. Products consume activities. A complex product requires more setups, more orders, and more inspections than a simple one. By tracing costs to activities first, and then tracing activities to products, we can allocate costs far more accurately. Think of it like splitting a restaurant bill. The traditional costing approach is like having 6 people at a table with a £180 bill, and everyone just pays £30 each. Simple, but is it fair? The ABC approach looks at what each person actually ordered. One person had a £50 steak and wine, another had a £15 salad, 2 people shared a £40 pizza, someone ordered a £20 dessert, and 3 people had coffee totaling £15. Now everyone pays for what they actually consumed. This is exactly what ABC does for product costing. Instead of spreading costs equally based on one simple measure, it traces costs based on actual consumption of activities. The person who ate the steak shouldn't pay the same as the person who had a salad, and a complex product shouldn't be charged the same overheads as a simple one. Exam tip. This restaurant analogy is excellent for written answers, explaining the philosophy of ABC. Remember it. Now let's learn the 3 essential building blocks of ABC. Understanding these terms is absolutely crucial for your exam. First, the cost pool. Think of a cost pool as a bucket where all costs related to a single business activity are collected. For example, all the costs associated with setting up machinery go into the machine setup cost pool. This includes the wages of the technicians who do the setups, any materials used during setup, and depreciation of setup equipment. Second, the cost driver. This is the most important concept in ABC. A cost driver is the factor that causes the cost of an activity. It's the measure of how many times an activity is performed. For machine setups, the cost driver would be the number of setups. For purchasing, it might be the number of purchase orders. The cost driver has a direct causal relationship with the cost. Third, the cost driver rate. This is the price of performing an activity one time. You calculate it by dividing the total cost in the pool by the total volume of the cost driver. For example, if your setup cost pool is £60,000 and you perform 120 setups per year, your cost driver rate is £500 per setup. Remember, cost pool is the what, the total costs. Cost driver is the why, what causes the cost. Cost driver rate is the how much, the cost per occurrence. Exam tip. Be very careful not to confuse cost pool and cost driver. The cost pool is the amount of money. The cost driver is the measure of activity. This is a common mistake that loses marks. Now let's learn the 5-step ABC process. I want you to remember the acronym GICAC. This will be your guide through every ABC calculation. G is for group. Group your overhead costs into distinct cost pools by activity. Similar costs that share the same driver go into the same pool. You might have pools for machine setups, purchasing, quality inspection, and machine running. I is for identify. Identify the appropriate cost driver for each pool. Ask yourself, what factor causes this cost to be incurred? For setup costs, it's the number of setups. For purchasing costs, it's the number of purchase orders. Choose drivers that have a clear causal relationship with the costs. C is for calculate. Calculate the cost driver rate for each activity. Divide the total cost pool by the total volume of the cost driver. This gives you the cost per unit of activity. A is for absorb. Absorb overhead costs into products based on their actual usage of each activity. Multiply the cost driver rate by how many times each product uses that activity. Then divide by the number of units to get overhead per unit. The final C is for calculate again. Calculate the full, true unit cost by adding together direct materials, direct labor, and all the absorbed overhead costs. Group. Identify, calculate, absorb, calculate. Memorize this sequence. It will structure your approach to every ABC question in the exam. Exam tip. Always verify your answer by checking that total overhead absorbed equals total overhead costs. If they don't match, you've made an error somewhere. Now let's see the shocking results when we apply ABC to oak and pine furniture. This table reveals the true cost distortion. For the standard bookshelf, traditional costing gave us approximately £90.55. But ABC reveals the true cost is only £77.10. The bookshelf was being overcosted by about 15%. We thought it cost more than it actually does. But look at the entertainment unit. Traditional costing said it costs £271.09. ABC shows the true cost is £540. The entertainment unit was being undercosted by an incredible £269. That's 99%. Let me say that again because it's so important. Traditional costing hid a £269 per unit loss on the entertainment unit, while simultaneously making the simple bookshelf appear less profitable than it truly was. This is the fog that ABC lifts. Without accurate costs, you're flying blind. You're making pricing decisions, product decisions, and strategic decisions based on numbers that are fundamentally wrong. Exam tip. Always remember the distortion pattern. High volume, simple products are consistently overcosted by traditional methods. Low volume, complex products are consistently undercosted. If you remember nothing else, remember this pattern. Why is the cost difference so dramatic? These pie charts tell the story. Traditional costing only sees production volume. ABC sees the real story of resource consumption. Look at production volume first. The entertainment unit represents only 5% of total units produced. 500 units out of 10,500 total. Under traditional costing, it would get roughly 5% of overheads. But now look at machine setups. The entertainment unit, with just 5% of volume, consumes 83% of all machine setups. Why? Because it's made in small batches, each requiring a fresh setup. Purchase orders? Even more extreme. The entertainment unit drives 87% of all purchase orders because its complex design requires many specialized components. Quality inspections? Again, 83%. Complex products need more checking. The entertainment unit is what we call a resource hog. It's devouring the majority of expensive overhead activities while representing only a tiny fraction of output. Traditional costing completely misses this. It charges the entertainment unit based on its 5% share of volume, not its 80+% share of activity consumption. This is the insight that ABC provides. Products should bear costs in proportion to the activities they consume, not in proportion to some arbitrary volume measure. Now, let's see the real-world consequences of getting costs wrong. Bad data leads to disastrous decisions in two critical areas. First, pricing strategy. If management believes the entertainment unit costs £290, they might price it at £350, thinking they're making a £60 profit per unit. But with a true cost of £540, they're actually losing £190 on every single unit sold. They think they're profitable, but they're hemorrhaging money. Meanwhile, they might look at the bookshelf and think, at £100 cost, we need to price this at £120 to make a decent margin. But the true cost is only £77. They could price it at £95, be far more competitive in the market, and still make a healthy profit. Instead, they're overpricing a profitable product and potentially losing market share to competitors. Second, product strategy. The sales team, seeing the apparent profit on the entertainment unit, might be incentivized to push it hard. Great margin on those units, let's sell more. But every additional sale of the entertainment unit actually accelerates the company's losses. Meanwhile, they might neglect the truly profitable, high-volume bookshelf. This is the real danger of cost distortion. It doesn't just give you wrong numbers. It leads you to make exactly the wrong decisions, pursuing unprofitable products while neglecting profitable ones. So what are the benefits of ABC? Let me give you another acronym to remember. PACE. P-A-C-E. The clarity from ABC empowers better decisions across the board. P is for pricing. With accurate costs, you can price complex products to ensure profitability, and price simple products competitively to win market share. You avoid cross-subsidization, where simple products unfairly carry the costs of complex ones. A is for activity and operations. ABC identifies your most expensive activities. If setups cost £500 each, maybe you should invest in quick change tooling or increase batch sizes. If purchasing is expensive, maybe consolidate suppliers or orders. You can drive operational excellence by managing the activities that drive costs. C is for cost control and strategy. You finally know which products and customers are truly profitable. You can make informed decisions about which product lines to grow, which to redesign, and which to discontinue. Strategy based on accurate data, not guesswork. E is for enhanced performance insight. ABC helps you understand the real drivers of your costs and profitability, not just the symptoms. You're treating the disease, not just the fever. PACE, pricing, activity management, cost control, enhanced insight. These are the strategic advantages that ABC provides. ABC sounds wonderful, but it's not right for every organization. Let's look at when ABC adds the most value and its limitations. ABC is most suitable when you have diverse products that vary in complexity and volume. Activity variation, where products consume resources differently. A high proportion of overheads, typically more than 40% of total costs. Complex production processes with many different activities. Signs that existing cost data might be wrong. For example, profits are down, despite selling supposedly profitable products. And crucially, the resources available for implementation. Remember the acronym DAPA. Diverse products, activity variation, proportion of overheads high, Production complexity. Existing costs seem wrong. Resources available. However, ABC also has significant disadvantages. First, high cost and complexity to implement. You need consultants, new software, and significant staff training. Second, it requires substantial time and data collection. You have to analyze activities across the organization and gather data on cost drivers. Third, some costs remain difficult to assign. What activity causes the CEO's salary or building depreciation? Some allocation is still arbitrary. Fourth, there's subjectivity in design. Different analysts might choose different activities, different drivers, different pools, and get different answers. For smaller businesses with simple operations, low overheads, or homogeneous products, the cost of implementing ABC might exceed the benefits. Exam tip. Questions asking you to recommend whether to implement ABC are common. Always consider both the benefits and the costs and limitations. This slide gives you a quick reference for matching cost pools to cost drivers. In the exam, you'll often need to identify appropriate cost drivers, so let's run through these common pairings. Machine setup costs. The driver is number of setups or production runs. Purchasing department costs. Number of purchase orders. Quality control costs. Number of inspections or tests. Machine running costs. Machine hours. Materials handling costs. Number of material movements. Order processing costs. Number of customer orders. Design department costs. Number of design hours. Delivery costs. Number of deliveries or delivery miles. Notice the pattern here. The cost driver always has a causal relationship with the cost. Purchasing costs are driven by purchase orders because placing orders is what the purchasing department does. Quality costs are driven by inspections because doing inspections is what quality control does. Ask yourself, what action or event causes this cost to happen? That's your cost driver. Exam tip. Memorize these common pairings. Exam questions often give you a cost pool and ask you to suggest an appropriate cost driver. Direct labor hours is almost never a good cost driver for ABC questions because that's what traditional costing uses. As we approach the end of this lesson, let's consolidate the 3 most important things you need to master for your exam. Number 1. The core flaw. You must be able to explain why traditional costing fails. It falsely assumes that production volume drives all overhead costs. It uses a single allocation base, typically labor hours or machine hours, and spreads costs accordingly. ABC corrects this by recognizing that activities drive costs and different products consume activities in different proportions. Number 2. The distortion pattern. Know the predictable outcome of this flaw. High volume, simple products are consistently overcosted under traditional methods because they're charged for activities they don't actually consume. Low volume, complex products are consistently undercosted because their heavy consumption of activities is hidden by their small share of volume. If the exam describes a scenario and asks which products are likely over or undercosted, this pattern is your answer. Number 3. The 5-step process. Be able to execute the GICAC calculation confidently and accurately. Group cost pools. Identify cost drivers. Calculate cost driver rates. Absorb costs into products. Calculate total unit cost. Practice this process until it's automatic. Most of the marks in ABC questions come from accurate calculations. Exam tip. Set out your workings clearly and label everything. Even if you make an arithmetic error, you can earn method marks for showing the correct approach. Let's close with the big picture. Activity-based costing is more than just a calculation method for finding a number. It's a management lens that provides the essential clarity needed to make winning decisions in a complex business world. Traditional costing creates a fog that distorts your view of profitability. ABC is the tool that lifts that fog. It shows you which products truly make money and which ones drain your resources. It reveals which activities are expensive and where you should focus improvement efforts. It transforms overhead allocation from arbitrary guesswork into precise, causal analysis. For your exam, remember the key concepts: cost pools, cost drivers, cost driver rates, and the GICAC process. Remember the distortion pattern: overcosting of simple products, undercosting of complex ones. Remember the advantages and when ABC is most suitable. Most importantly, understand that ABC isn't just academic theory. It's a practical tool that real businesses use to make better decisions. When you master ABC, you're not just preparing for an exam. You're developing genuine management accounting expertise. Thank you for watching. Good luck with your studies and your AAT Level 4 exam. In the next chapter, we'll continue building your management accounting toolkit with another essential topic. Until then, review this material, practice the calculations, and remember, clarity in costing leads to clarity in decision-making.